Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook. All right, well, September is not disappointing as far as the downside is concerned. Once again, it's probably going to be proven that September is going to be a down month on the calendar as far as the major indices are concerned. So we looked on, and rightfully so, we talked about doing a butterfly on last Friday's show. And in the show, I kind of mentioned that we wanted to be in the butterfly going into Monday. And since Monday, the markets have had a little bit of struggle, not a ton of struggle, but the markets have definitely taken a turn for the worst. And it has a lot to do with the budget talks that are going on in Congress. On Saturday is the witching hour, in that October 1st is when the new budgets start. And it's possible for sections of the government to actually be closed down because of the concerns over the debt. And it's not a debt ceiling battle, if you will, in that if the debt ceiling doesn't get raised, the marketplace or the entire government gets shut down. But there will be sections of the government that are at risk here, which is also in this environment a rough environment. And rightfully so, where we have interest rates increasing. We got the Fed saying that they still may increase rates in November by a quarter of a point, depending on the numbers. And that is really obviously affecting the interest that is being paid on this large debt. And if the 10-year still stays at 4.5% or higher, I think those talks will without any relief in the rise in interest rates, this will be a very hot topic. And it makes me nervous about what's going on in the marketplace then. And the VIX is finally showing that nervousness. So I'm just going to take a peek at the VIX quote here. The VIX is now at 1884. We did it, and I guess I actually mentioned this, so I don't want to beat a dead horse, but we did a VIX trade. We bought some 17 calls. We sold a put spread to pay for it. As a matter of fact, on the Russell Rhodes edition of Options Guide TV, which was last Wednesday. We'll actually put that URL in the chat box for you. But that show, we talked a lot about, why was the VIX at this level? Why was the VIX trading down around 14, 15%? Both Russell and I were kind of surprised at that level in the VIX. And then we got the run up, and we did a strategy on Options Guide TV almost a month ago. And, we were a day late and $1 short. We used the September 20th expiration, which was right before the Fed meeting. And we obviously should have went out into October. And then this trade would have, it would have worked out really well. But that's one of the biggest issues with option trading, especially in the VIX, is to be right on your forecast and not give your strategy enough time to play out. So at this point in time, I could consider doing another VIX trade on the show, but we'll take advantage of the fact that that our outlook on our SPX paper trade was correct. So we need to address that fact. The downside here on the SPX trade is that we went out too far in time. We went out beyond the start of the new budget. We had an October 3rd expiration on it, and the market has came down in a hurry. Ever since we put on the trade, the market actually has started to work its way down, and probably would have got out of the trade a little bit earlier, but now we need to look at that trade. And I also want to say this on Options Guide TV. If you are on YouTube, you can go in the chat box. You can ask any questions about any of the trades that we have had here. We're going to start tracking these trades a little bit better, maybe do a little bit of paper trading on some of these positions. The paper trade feature, we can't use the SPX, and that's one of my favorite things to do a butterfly in. But we can do in the SPY and other, and obviously any of the Magnificent Seven, all the other very popular underlyings to trade. Okay, so let's run to the options grid and let's set up the trade. Wanted to highlight when we did the trade in the SPX last Wednesday, the market, and I'm going to have to lean forward here a little bit, 43.53 is a very small number on my screenshot. And we went out and we sold, we used the October 3rd expiration, as I mentioned, and we bought the 43.05, sold the 42.85, and bought the 42.65. You can see from the Trade Hawk options grid that in that expiration, October 3rd, and I always want to make sure that it says that expiration right over here, that in that expiration, it shows us where the most at the money option is at. So we bought this one, we sold this one. So we flew through our middle strike and our butterfly. And that happened just recently. The SPX right now is down 235. So it happened at some point in time yesterday. And we can look at the chart, but I don't think I want to. Let's just set up this trade and see where we're at. We only paid $1 for it. It would be better if we were a little closer to the expiration, and that always happens, especially in the SPX options, because they have so much premium because the value of the index is so high. It's not necessarily just that the VIX is spiked, but it's that the value of the underlying is so high. And if you think of options as where they really came from as pure insurance products, you know, it's more expensive to insure a Bentley than it is a Chevy Cavalier, if you will, right? So the more expensive the underlying, the more expensive the option contracts. In particular, the at-the-money option contracts is where a lot of the juice is. And when you do a butterfly and you're correct on your forecast, you need that option contract in particular to wither away. And that only really happens closer to that expiration date. So we're at 42.85. Then we need to go 20 points down and buy the 42.65. And if I click right here, it puts that leg in here. And here's the options grid. Here's where the market is at. And a nice, oh, we hit the wrong one there. So let's just click, let's change that and go and remove. And we'll add one more. Oh, I don't need to add one more. Why am I adding one more? Let's just go back to one. 1 by 2 by 1 butterfly. All right. So here is the thing, is that we mentioned on Friday's show that if it moves too quick, don't get greedy. And that is the issue here, because we have this butterfly that has moved quickly. And I said, if you double on a butterfly, you've done well. But it's also real tough to be happy with that gain. And, you know, the issue here is that we only paid $1 for this trade. We could have bought a lot of them. We would have sounded good at the cocktail party, right? But on Options Guy TV, we always just kind of look at one unit and let you decide what type of risk you would want in your paper trade portfolio, because it's all about just learning here on Options Guy TV. But this obviously was probably a doubler. I don't know exactly where it would have landed when it hit that 42.85. We would have thought, we would have looked to get out of that trade, and I would want to get out of that trade right now. I'm nervous that the market could continue on down and go beyond. So if we paid $1 and we could sell it for $2, should have got out of the trade, and that was our goal. That was the outlook. But it's sad to be this correct on your forecast and only get rewarded by doubling. And I say that jokingly, right? Because we did double, mainly because the maximum that this trade could trade for is $20. So if I did this position and I put it on and it came down and it reached that price, well, then I would get out. Here's the biggest thing. If we're trading options and we have realistic expectations, which that's what Options Guy TV is all about, in that we're using real live markets. Every once in a while I get surprised by what will happen. This does not surprise me at all. We could have did a little bit shorter. If we would have went in and like just look at the 0 day, and maybe let's do that. Let's keep these marks and let's look at what, well, I would not have done a 0 day. I would have used the Friday expiration, which would have been the 29th, mainly because they're the more liquid. Well, they're really liquid in SPX anyways, but that's the expiration that I probably would have chose if we did a shorter term one, and that would have been the 29th. And let's look at the difference in price and see what we can learn here. Oh, just wait. I see we have a question. Yay. All right. Any other questions? Please feel free to put them in the chat box. But I do see a question here before I move on. And and look at this trade. Let's put that question up. And I do see, all right, we're trying to put the question up. Can someone put the question up? There you go. If you had more than one butterfly, would you take some profit? Well, okay, we always look at a one lot usually on Options Guy TV here. But if I did do a 5 lot, maybe, so that would have been $500 because we paid $1 for the trade. Now, obviously, you always got to add in commissions, but it would have been $500. Well, when it hit 42.85 and I had a doubler, probably, I don't know exactly where the market was at when I hit it. Might have been more than a doubler, but yeah, I would be okay with you taking off either 2 or 3 contracts, right? And letting the other contracts ride. Now, that would really be dependent on my outlook for the market. So if it hits 42.85 and it's got this momentum to the downside, I don't know if I want to. I maybe take 2 of them. I want to take at least 3 of them off and maybe leave 2 on, right? Because obviously we don't know where it's going to go, but the big news event hasn't happened. We haven't gotten to the budget talks. So if you leave 1 or 2 on, maybe we come to we kick the can down the road and get some type of spending bill, which I'm really thinking Congress might do. That's about the only thing that can happen right now from listening to the news. I don't want to opine on politics at all, but it doesn't seem like they're going to get a full-blown budget by the first, but they might kick the can down the road. And if that happens, the market might just bounce back. And we're down at 42.72, so we're below this strike right now, 42.75 that I'm highlighting. And if that is the case, well, we might get that bounce back. We might get that bounce back to that short strike. And if it comes back to that 42.85, and we get a couple more days for the option contracts to wither away, get that time decay factor to work. And if you're correct on your forecast, time decay is your friend and implied volatility is your friend. And that also could drop off. So the more I even think about it, yeah, I think I would sell 3 and remain in 2 if I had a 5 lot. That's the way I might have approached this. Okay. Just because if we do get a little bit of a release in implied volatility, that will also help this position. Part of the reason why it only doubled is that implied vol went from 14 when we put on the trade to 18 on the VIX, which would have affected these option contracts quite a bit. The implied volatility on this at the money option is at 17 right now, just by looking at the implied vol column on that at the money option on that contract that we sold in the SPX. Okay, so let's do real live pricing, right? We were correct on our forecast. If we had picked, well, I mean, you can't always, there's no way that you can know when the move is going to happen. That's just not possible unless you have a crystal ball. That works, by the way, not just a real crystal ball, but you need one that actually tells the future. I would have considered doing the September 29th expiration, which is what we were looking at in the VIX, which was the 20th, which was the expiration before the Fed had their meeting. But this would be that expiration, right? So let's go in and look at these strikes. So these are going to go away on the September 29th expiration and see what that is trading for. It's going to be a lot about where that volatility is at too. Okay, so let's do that. Just a fun little experiment. All right, so now we're back to the options grid. Thank you, guys. We're going to buy the 43, sell the 42.85. So I click on the bid, and I'm going to click on that. Oh, I got to get rid of this down here. So let's start over. Here we go. We're going to buy the 43.05. We're going to sell the 42.85, and we got to sell 2 of them. So I clicked on it once. It puts a leg in. Let's add another leg in. We're going to go down to the 42.65, and we click on that. So the difference is, well, it's substantial. It's $2.35 on the mid. I see it dancing around. We'll call it 240. We'll put it right in there. Okay, so 240 on the midpoint. And that's versus 180 on our longer term trade. So you're looking at 60 cents difference. So still a lot of juice in those option contracts, right? Even though we're approaching that expiration date. And the only downside here is I wish it was at the money. It's not at the money. It's 10 points in the money. It would help a lot if we were at the 42.85, but $2.40, nothing to sneeze at. And let's change up this, and we're going to go this route with it. And let's look at the 0 date expiration. I probably would not have traded that, but let's just look at it to see where we end up in real time with these prices. So that's the September 27th. So very easily you can do it within the chains, or you can go in and just click all of these different expirations, and the strikes will stay there, but we will go back 2 days. But 2 days in the SPX and the butterfly is a big deal. Boom, $5.65. Right? Still not even close to that $20 mark. But then again, we're not at the strike, and I keep forgetting that. We're at 42.75. We're 10 points beyond the middle strike. So we're $5.65, but almost doubled what we would have made on the 2-day option contract. What's my moral? Moral to the story is that if you're trading things like the SPX that have a ton of premium in the at-the-money option contracts, the timing of your trade is important. So it's important to have a realistic expectation before you put the trade on. We had the benefit of a paper trade that worked for us. We had a plan that if it went from $1 down to $2 in the short term, that we would get out of that trade. And right now, based off of the question that we had, and if you have any other questions, please put them in the chat box on YouTube. And if you look at that, and you did have it come down to this level, and you had a few more days, well, maybe we would sell 3/4 of the position and hold on to the last 1 or 2 contracts inside our butterfly. And whenever I talk about a butterfly, that's 1 unit, and that's the way you look at it in the advanced option trading world, right? You're sending this to the floor as a unit. It's a 1/2/1 ratio. And that is 1 unit. It fills at 1 price. If they can't fill the 1/2/1, well, then they don't fill anything. They're never going to fill just one of the puts on the long side and not fill the short side, right? It has to come in as a unit, as a package. But this was a great opportunity to talk a little bit about pricing and how that all plays out and how that all works together. Okay, so I've been saying this for a while, and actually I went to the second, and it's showing our strikes now. This is actually that expiration with 0 days remaining, highlighting over here in the options grid where we're at. But it's hard to get long the market in September in general and what's going on with the market. The one stalwart of the economy has been the consumer, the worker, wage inflation. This is kind of one of the things that is keeping, I guess, inflation from getting down to the 2% level that the Fed would like. And it's very obvious when you see record union contracts like UPS came out with a $170,000 package for their drivers, and that's with benefits and pay. So I don't know how much of that is benefits. And now you have the UAW strike going on, and they're looking for somewhere around a 40% raise in the, I guess, longer term. But that's what they're looking to try to negotiate, and then also trying to get a shorter work week, which I find that interesting. So with that said, the consumer is strong. And we saw that in Costco. There's been a lot of problems with a lot of stores with theft, at least in this earnings round. It got mentioned a lot. Target today announced that they're actually going to close down some stores that have been targeted for theft. Costco, they were, a lot of the pundits on the shows were kind of surprised that Costco isn't having as much problem with theft. But if you look the way Costco is laid out, they have a ginormous lobby, a ginormous checkout area. You got to have a membership card to get in. All these different things that I think just kind of deter it. It's much easier to just run into a store where you don't need a membership card to run into the store, right? Not that, can you just see when they do a smash and grab, all 5 of those people coming in and showing their membership card to Costco before they do their smash and grab so that they can get in the front door. So it kind of makes sense to me that Costco isn't having those problems. And they just announced earnings and they did fairly well. And the market is up a little bit. So here's my moral of my story is I'm saying it's been hard to try to get long. I think I'm going to get long Costco today on a paper trade. And we're going to once again do a fig leaf. We're going to go deeper in the money, buy longer term options. You can stay the course with the SPX and keep getting bearish, but I don't want to beat that theme to death because we got bearish in the QQQ, got bearish in the SPX. So now let's go in and look at Costco. They've announced earnings, and this is when I like to, if I want to get bullish on a stock, that even if there are some headwinds in the marketplace, if we do see the economy turning, kind of going the other direction, and maybe the recession talks come back, interest rates still continuing to go up. 10-year actually right now is 4.55. So that's where the yield is at right now. So we are, some scary times. We still got November and October, but now this is when I might want to get ready for the Christmas season, right? And Costco would be a stock that I would be comfortable with. If you like that space, this would be one of the retailers based off of everything they just said on their earnings. It's up 1.66% with strong earnings and strong comments, actually saying that inflation is waning, not only in their food products, but also in the retail side. So they had a lot of good things to say about inflation, which is the major concern. It's probably some of the best inflation news that we've had from a retailer to date out of all of the earnings forecasts that have came through. Okay, so I'm getting a little long in the tooth. If you have any questions, please ask. Please put them in the chat box on YouTube, and I will try to address them. All right, so I definitely want to go out into the new year. And whenever I'm buying longer term option contracts, I'm usually going to look into the new year because that gives you an opportunity to just look at the tax bill in the new year. Now, if you're in a retirement account, which at Tradier we allow you to trade inside an IRA account with the proper approvals. So this is a very popular strategy that I've seen done in many IRA accounts. But then the tax doesn't really matter as much, meaning that I could do the November as opposed to the January expiration, which I'm highlighting on the chart. But now I'm going to go all the way out to the February expiration. I think 142 days is a good range, gives us some good time in here. But I'm nervous because I've already said that about the marketplace. But we got to try to pick a bottom a little bit in what's going to happen with the marketplace. And hopefully we get some type of resolution before the first. If we don't, everything's going to get beat up. So it's a little bit of nerve-wracking, but we have to persevere on Options Guy TV. We do 3 shows a week, so we got to come up with new trades. And I think what's just more important about all of this is to talk about why we would pick the stock and why we would sell this particular strike. I think that is probably the biggest thing about using real markets on a live podcast. And my biggest theme here is that I'm going to buy the longer term option. And if I wasn't nervous about the markets, I probably wouldn't sell the call against it right away. I would wait and see if I got a little bit of a run up and then consider legging in to the fig leaf trade, or otherwise known as a leveraged covered call. But if you don't know what a fig leaf is, then you can just run to optionsplaybook.com and you can check that out. It's available in the strategies tab. Okay, so we're going to do this February expiration. The theme is, with a lot of fig leaves, we'll sometimes use LEAP options, which just stands for long-term equity anticipation securities. They just go out more than 9 months in time. Chicago Board Option Exchange, which is now SIBO Global Markets, just thought it would be fun to confuse people with something that's fancy and acronym. I don't know. The CBOE turned their acronym into the name of their exchange. So there you have it. So I need an 80 delta. And usually inside the TradeHawk software, it's very simple to just go to where that the shading is. Well, at least in my setup, I always like to have a 1 standard deviation move. And it's awesome in the TradeHawk options grid that we highlight that. So we're going down at 480, 81 delta here, 90 by 95. It's a little bit expensive. I think I'm going to go and do the 4090, which is a 79 delta by looking at this. And this is going to be the option contract that we are going to buy. So we're going to clear out our trade. This will be our paper trade for this week, or for this day, for this Wednesday. And we're going to sell that 490 strike. Now, here's what makes the trade a fig leaf. We always kind of say that you're kind of covered. And here's the reason why with the fig leaf is that you don't own the stock. So we're going to be selling an expiration that is prior to the February expiration. And that makes that adds a big level of complexity, because you really don't want to be assigned on that shorter term option because you don't own the stock. The brokerage firm considers you covered because you have the right to buy the stock at a lower price than the right to sell the stock at, or the obligation to sell the stock. But if that happens, you got to do something, because you don't want to lose all the time premium that is in your option contract. And if we look at the extrinsic value inside the chains here, which is all time value, extrinsic means time, not intrinsic, which means real in the money option contract, you still got $16 worth of time. So you definitely would not want to exercise this option contract and give that up. But we need to battle that time decay, which is a real thing. That's a lot of money in that. So here's what we're going to do. They just announced earnings, so I do not want to do this before earnings. I don't want to sell the call and have that risk of that earnings report driving it or gap opening above my shorter term strike. So I'm going to go in and I'm going to sell, and I'm going to air, like if I'm doing a regular cover call, I might look at the October 20th expiration, which is 23 days away, but I want to be shorter. I don't want to be assigned. And I'm also going to give up a little bit of premium, because if I'm paying $87 for this as opposed to $562 to buy 100 shares, I'm getting a surrogate for the stock, something that acts like the stock, but it is not. There it goes. Okay. But a surrogate for the stock, but it's not the stock. It's just that simple. It's not the stock. And this is a real option contract. So if we pay 87 times 100, we got $8,700. 562 divided by 562 divided by what did we say? 87 equals 87 divided by 562 equals 15%. So we're putting up 15% of our stock price. That's the maximum that we can lose on the trade. And I always look at it this way, that if it does come down to our strike price, I'm going to probably get out of that trade. I don't want to lose that maximum. But in this marketplace, prior to the downturn, a lot of people would have taken 15%, but we're not going to let that happen. We're going to, if it gets down to our strike price, we're going to sell this option contract and get out. Okay, so let's look at the option. And I do see we got another question, and I'll answer that. I'll address that in just 1 second here. But let me set up this call option. Notice my expiration changed. We're going to do the 29th, right there. No, we're not going to do the 29th. We're going to do 16 days out. And it does make me nervous because the budget talks are on the first, or the new budget supposed to come out on the first. So, but with that said, we're going to go far out of the money. So one standard deviation move is between 585 and 590. I'm going to, maybe if I own the stock, I would go further out and I would look right at the one standard deviation move, because I don't mind it getting called away. I don't want to get called away. So I'm going to go down to the up to the 590 strike. As a matter of fact, I'm going to do the 595. Why? Because I'm getting a decent price for it. 140 is the bid on the 590. I would rather just take in 90 cents, go beyond the one standard deviation move, and sell that against my $87 option as opposed to my $563 option. And this will be the fig leaf. That's simple. Net debit to the account. So we're going to bring in that dollar. And now our goal is, especially in the short term, until we feel a little bit more better about the marketplace, is to sell a couple of these. Try to bring down that $15 in premium that we're paying in time value, and wither away at that, and hopefully do that as we get a run up in that underlying stock. And I'm doing this, I'm selling it right now because I'm a little nervous about the marketplace. And if I want to get long something, I want to sell some premium against it. VIX is up, volatility is up in the markets in general. So there you have it. All right, another question. Let's put that one up. If you decide to sell a call on the fig leaf, would you consider using the profit to buy a long put? Okay, so what we're talking about there is, instead of just selling the call, would you want to collar the position? And so if I buy a deep in the money option contract and I sell a call against it, and then I go and buy a put below the marketplace, that would be some weird collar. Actually, I don't know a name of the strategy for it, but I'm collaring my surrogate for the stock, which would be that deep in the money call. And the answer is no. That gets too convoluted with 3 option contracts. I might do that on the stock where I own the stock. I'm nervous maybe going into an earnings report, and I will sell a far out of the money option contract and use those proceeds to buy a put so that I know where my risks are. I give up some opportunity on the upside to protect myself on the downside. And that's just a good old collar. And you can see that inside the options playbook too. In this instance, if I was going to do that, I would just do a long call spread. Well, actually, that's actually what we have going on here is this is a diagonal spread, otherwise known as a leverage covered call. But the fact that we're buying the call acts as a put. All right, so let me say that again. The fact that we're buying the call acts as a put. So the synthetic, that's the word. Man, that was tough. I had to pull that one out of my head. The synthetic relationship, if you are long a call and you look at the profit and loss graph for a long call, and you look at a profit and loss graph for buying a put and buying the stock, they have the exact same profit and loss graph. You have unlimited upside if you own the stock, and you have limited and known downside if you buy the put. And if you buy the long call, you have limited and known upside until that expiration date on the long call, but you have limited and known downside because the risk is the premium that you paid for it. So there's no need to buy the put because that's basically what we're creating here by doing this fig leaf. We're creating a weird collar, if you will, and limiting our downside to 15%. But if the stock ever came down to our short strike or our long strike, the 490 strike in this instance, and I'll jump back to the screen a little bit here. If we ever come back to the 490, that strike right there, we're going to look to sell that long call and just get out of it. We're going to try to capture as much of the at the money time premium as possible. All right. So, oh, wow. I got real long in the tooth today. We're 4 minutes over. If last call for questions, if we can. And if we do not have any more questions, I guess that's going to be it for this edition of Options Guy TV. Please click subscribe, ring the bell, pound that thumbs up. It helps us out a lot. Tell your friends and family. We want to make this as interactive of a show as we possibly can. So thanks for coming, everyone, and we'll see you on the next edition of Options Guy TV.